Let's talk to Tim Gregory. He's the Chief Investment Manager for Vermeer Investment Management. Morning to you, young Tim.
Morning, Nick.
Right, we won't talk marathons, 5 hours, well done. Let's kick off with my friend Mr. Carney, a man who can do the London Marathon in 3.5 hours.
Impressive.
Extraordinary, super impressive.
Very impressive.
UK interest rates.
Well,
everyone's telling me it's happening in May.
Yeah.
Okay, I look at short sterling, I look at a number of different indicators, and what's expected to happen doesn't normally happen.
Well, obviously that is correct that expectations are still that rates will go up. The currency has been quite strong. There's been an element of weak dollar, and no doubt we'll come on to elements that might have caused that. But sterling has recovered a lot of the ground it lost post-Brexit and rallied strongly. And Mr. Carney has indicated that rates are going to go up. Now, I can't see personally on the evidence of current trading in the high street and in what I hear from auto retailers and what I hear from connections I have in the sort of housing estate, real estate industry.
We're slowing, right?
That slowed.
Yep.
And the economy's not doing well, particularly.
Okay,
so I find it hard to understand why rates would need to go up in May, and if you throw in additional uncertainty caused by possible trade wars and all these other elements, I can't see any reason to press ahead, and I would be being patient and waiting to see what developed.
Okay, I tend to agree with that. Right, trade wars. Okay, big headlines, tit for tat. What's going on?
Well, that's a very good question, and I would like to know the answer myself, because I think if you just look at the market, even in the short period of time since we were last chatting, we had the 50 billion, and then the apparent rowing back of those remarks, then the sort of reinforcement, and then the Chinese responding quite optically aggressively with their comments about putting tariffs on products like soybeans, agricultural products, right to the heartland of Republican Trump areas of the US. So quite a aggressive response, you might say, leading to yet another upping of the ante to 100 billion of products that might now come in. So day to day, the market has become impossible. We are up 2%, we're down 2%. We've had 7, I think, trading days this year of falls of more than 2%. We didn't have any in 2017, and I don't think there had been one for 17 months prior to the falls that we've seen. So volatility day to day has become impossible. So really here, one has to set a course of, for my money, of balance and of caution. So we have more cash, as I said previously, and we've got a little bit more balance in the portfolio. As we talked about before, 6 weeks ago, positioning was all about rising bond yields, risk of inflation, rising interest rates. Investors wanted to be long of financial areas of the market, more cyclical areas of the market because growth was good. Now it's much more careful. Having said that, 2 things to say more positively. Now that markets have come back to 2,600 on the S&P 500, we're a long way from that 2870 that we were in late January, which I said I thought would be a struggle to get back over that. Well, there's room now to run if we see some better news, some more calming news, back up to those sorts of levels with quite a nice percentage rise, because we're at 270 odd points away from that. So it's more than a 10% upside to that sort of level. And the results season that's coming up in the US should be very good. Expectations for earnings growth for this quarter are 18%.
Right.
Which is going to be the best quarter we've seen in a very long time.
Right.
So a combination of falls in valuations in the market and expected strong earnings growth, not just this quarter, but for the year as a whole. But of course, who knows what happens going forward because of the uncertainty. But if consensus forecasts are correct, valuations have gone from what I thought were clearly stretched and expensive to fairer, and to a position where there are selective quality investments that you can make, assuming things calm down, that look good again.
On that note, young Tim, always good to see you. I want to talk about marathons, but we'll do that next time. We'll see you in 2 weeks' time.
Thanks very much, Nick.
Thank you.
Thank you.